Welcome to the latest episode of High Stakes. I'm Paige Soya, the managing partner of K Street Capital, and today's episode is all about what LPs want from VC fund managers, which a lot of people, especially founders, don't realize that VCs have to go out and fundraise too. That's where the money comes from, that they invest in your company, and that creates certain guidelines and certain things that they care about that ultimately trickle down to the investments they make and the decisions they make with founders. So anyway, we have a special guest on today, Nasir Qadree, who's the founder and managing partner of Zeal Capital. And so before we start, I guess, Nasir, do you want to just introduce yourself and share a little bit about your background?
Of course. First of all, Paige, it's great to be with you. I, as you mentioned, managing partner at a firm called Zeal Capital Partners based in Washington, D.C. We're in each other's backyards. And the focus of our firm is to back exceptional manager teams that are rethinking the building blocks of wealth, but by way of building solutions and businesses across three specific categories, $3 trillion categories: healthcare, financial services, technology, and the future of learning and work. I believe, and as a firm, we believe that these are three categories that are critical also to turbocharging economic mobility. We're also a seed stage firm, and so we invest at the earliest stages and really help our companies think thoughtfully about becoming market leaders, their go-to-market strategy, building team, culture, beefing up their investor Rolodex. Those are some of the key aspects of our portfolio post-investment value add.
Awesome. And you just closed Fund 2, so congratulations.
We did. Paige, this was hard. I learned so much. I'm more humble than you gotta have conviction, but it definitely humbles you when you navigate a very tough fundraising market, and just also so grateful. I think I'm a bit of a history buff. If you look at the history of venture capital in general, some of the most iconic businesses came out during the dot-com era, during the '08 era, even 5-6 years ago, and now we're in the AI era. And so while fundraising is challenging, founders are stepping up, and I think you're going to see a lot of innovative tools. So it's a privilege to be liquid and have dry powder to back these, hopefully, category-defining companies.
I could not agree more. And if you don't mind sharing, how big was your Fund 1 and what was the vintage year? And then Fund 2, how big is Fund 2?
For sure. Zeal Capital Partners, we invest out of 3 accounts. The first account is Zeal Fund 1, which is $54 million, which is a 2020 vintage. What a time, as you think about fast forwarding where we are today. We also partnered with Barclays, where we also manage $50 million for our pre-seed strategy, training the next generation of diverse entrepreneurs and next generation of venture investors through our Scout program. And then the more recent vintage is Zeal Fund 2 at $82 million. Building on top of Fund 1, I think the biggest difference is that the fund size obviously is a little larger. We can write larger checks, anywhere between 1.2 to 2.5. We, like Fund 1, step up and lead deals. If you're a category-specific strategy, I believe that you inherently go deeper and you're smarter, and so you have a bit more conviction at the earliest stages. And we introduce healthcare as a third category. If you look at Fund 1, we only did fintech and the future of learning and work. The idea was, if we're truly going to focus on backing innovations, focusing on turbocharging economic mobility, then you can't discount the role that healthcare plays, particularly health equity. And so I'm just really excited and privileged to be in touch with the game-changing CEOs.
Yeah, so maybe share a little bit about what you learned, especially from this fundraise, versus the fundraise for the first fund. And I guess the middle fund was a separate vehicle, so maybe we won't talk about that as much. But
sure.
And what you learned and what LPs really care about that are putting money into the asset class of early stage venture right now.
When I think about the attributes of what limited partners care most about, and even reflecting on the success and the challenge of raising and closing Zeal Fund 2, they wanted to see for Fund 1, did Zeal actually practice what they preach. So what they pitched us in Foles theory versus action, did they actually do it? And the answer to that was unequivocally yes. We said we'll underwrite between 20 to 25 deals. We did 22 deals, 18 are active. We shared that we would step up and lead deals, not all of our deals, but a healthy amount. We led 12 deals out of the 22 deals. We said we'll reach 7 to 12% ownership. On average, we are 8.1%. And we shared that we would become thought leaders and put ourselves out there and really invest in our brand as a category, new category specific investment mandate. And fast forward 5 years later, we got a long way to go because what they really care about, obviously, is a no-brainer, is DPI and realizations. But this is venture capital, right? And so it's going to take a lot of time for those companies to realize. But in the interim, it's just really digging into my earlier point, supporting a portfolio of companies where we believe we have an edge and spike, which is other aspects outside of capital.
Yeah. And I know you've got a pretty good mix of institutional investors and also individuals. At least I remember that being the case. One. Maybe talk a little bit about that and how the type of investors you have impacts the strategy and like what you're doing and what they care about.
That's a great question. When you think about our strategy, financial technology, healthcare, and the future of learning and work, and you parallel that with the LP makeup base, and you look for commercial partnerships, obviously M&A opportunity because they have visibility to understand how these companies could potentially impact their respective businesses and corporations. Fund 1 and even Fund 2 really supports, and I'd argue, allows us to compete in competitive deals, right? And so for Fund 1 and Fund 2, we have pretty much every financial institution from Citi to M&T Bank to Wells Fargo. And then you have payments companies such as PayPal, who anchored us and put us in business, Capital G, Google, or Alphabet. They having a blue chip technology company have exposure as well. And when you're going out sourcing deals and you find yourself in competition, maybe with some other term sheets, it does help you in terms of founders recognizing that they're not just getting the small and mighty Zeal team, but they're getting this expansive institutional global LP base as well. The other is it's LPs like SHRM, the Society for HR Management. When you think about your future of learning and work, where you're finding CRHOs and chief development learning officers are looking for new platforms to think about worker and learner enablement, reskilling, upskilling, rethinking certifications and badging degrees, alternative pathways to 2 and 4 year degrees. That's partnering with the 30,000+ membership base of SHRM, for example, the Society for HR Management, is a great strategic partnership. And now that we have healthcare as a third category, it was great to welcome Blue Cross Blue Shield, Zafra Investments onto the platform, and that too speaks to the firm's credibility around this new sector in healthcare. I think the sectors and the investment strategy aside, as a general partner of the firm, it was also important for me to bring on mentors, those who built story franchises. And while they can definitely offer deal flow, I was excited to have them in my corner for firm building purposes. And two that I'll name that have been instrumental. One is Jason Green, who's now the GP Emeritus of Emergence, Early Background Build, and Zoom, and early seed investor in Salesforce, the best SaaS venture firm, I believe, in my opinion, of all of venture. But they said, Nasir, these were my pitfalls. This is how I thought about building talent and brand and portfolio construction. The other is Scott Sandell, CIO and CEO of NEA, and one of his former counterparts, Mark Perry, former longtime GP at NEA. And those three gentlemen have been so instrumental to me personally. And I think that combination of strategic limited partners at the institutional and corporate level that align with their categories, and you couple that with firm building GP, focusing on firm building, I think that's a great mixture balance of limited partners.
That's incredible. So they're mentors, but they're also your LPs.
Yeah. And yeah, it was, yes, they are. And I think it has me reflecting often, Paige, around mentors can see so much in you that, whoa, this is differentiated. This is something that I feel like I have an early leg up on because of how close I am to Nasir and his strategy and us having tough conversations and his ability to execute and then them doing their own reference checks and learning about me from other people. And so I think that's admirable and exciting. It's actually, I live by the creed, to whom much is given, much is required. And I too plan to pay it forward. I think it's important as we think about training the next generation of venture capitalists that I become a Scott Sandell and a Jason Green and Leonard Marcus from Edison Private Equity Group as well. I appreciate it for sure.
Yeah. So another question I have for you, because this comes up a lot, like I've personally invested in venture funds as an LP, and also K Street has, as I'm sure you have too. And now we have also a fund of fund strategy at K Street that invests in fund managers as well. Right. But a lot of people ask me, like, potential LPs or people thinking about wanting to invest in venture, and they certainly could, they're accredited investors, but they've just never done it before. What do you think how does someone decide that they want to be in this asset class? As an LP.
I think you got to do your homework and understand the structure of venture capital. I had one close friend. I've known this guy since we were kids, and he was clearly a little liquid where he wanted to put some capital to work. And he said, I want to put in $100,000 in Zeal. And he was ready to write me a $100,000 check as if I was an entrepreneur, a company. Yeah. And I said, wait, it doesn't work that way. And in fact, it works much better the way I'm about to explain to you versus investing in a company. A company, you have the wire tomorrow, right? The entire $100,000. And so I had to educate him around the drawdown that it happens throughout the life cycle of the fund when we have deals that we're excited about. And it's only a percentage. Usually it's 2-3% of your total commitment. And so I give that example because that's the first, I think, exercise for any investor who's looking to invest in venture capital or anywhere across the private markets. I think number two is it's a long haul in terms of liquidity, and there's a lot of news around companies reaching IPO, and that's when folks who get excited and find venture capital interesting. It's when they read those articles, but they don't understand, Paige, as what went on 10 years ago or 7 years ago, sometimes 15 years ago. That's when the company really got started, and understand the long game with venture, but also make sure you're diversified. While the data says that's very clear, I do believe in the consistent data that venture capital returns typically outperform the S&P 500. That is attractive to limited partners and particularly individuals who are less educated and nuanced in venture capital. But again, I think it's like being diversified, doing your homework on the model, really understanding the crux of that fund manager's mandate. And in many cases, you're clearly liquid and you got to where you are, or even if it's an institution, like what is it in it outside of capital? Every venture capital firm is very lean. So where do you see yourself adding value as well? I think any GP would appreciate an LP adding value outside of being an LP.
Yeah. Yeah, I think, at least in my experience, a lot of our LPs, they want to make money, right? That's the primary reason why you invest in a financial vehicle. But they don't just want to make money. Like maybe they've made money in other ways, and they want to use it as a way to learn, actually, to learn about not venture necessarily, but learn about new technology and trends in the industry, and just understand how those businesses are viewing their own metrics, and maybe they can apply those metrics they learned to their own business or to whatever they do in their career. So I think that is a big reason why a lot of people initially get interested in venture, or like you said, maybe they've got like a buddy that they were playing golf with and they hear about this deal that went bonkers and now they have FOMO and they're like, I got to get into this year.
Exactly. No, it is always interesting how and why LPs gain conviction in an opportunity. But I do think, at least where I sit, I continue to find myself educating and making sure you're an accredited investor. I don't want to get in trouble. And I think that's important work for fund managers to do as they think about their LP cap table.
And what about for institutions? You've done a phenomenal job bringing in, I don't know if all those institutionals that you mentioned earlier are just new into Fund 2 or if they were in Fund 1, but like you've done an amazing job bringing a lot of them in. And I don't know if they all have been investing historically in early stage venture or an emerging manager. Like at some point they make a decision that they want to add that to their portfolio. And what do you think drives them to do that?
Yeah, that's a great question. 80% of Zeal Fund 1 limited partners continue their exposure in Zeal 2. Of the 80%, about 38% increased their investment. And to your question, there were and there still are limited partners across the Zeal 1 and 2 portfolio that historically they did not have exposure into venture capital, but they made a decision, whether it's for strategic or purely financial purposes, to make sure they have some form of exposure. And a lot of their interest is in the emerging manager space instead of the storied franchises, because it's more difficult even to get access to name your storied venture capital firm. The data also says that emerging managers, particularly emerging managers, tend to outperform as well. They're a bit more hungry. They're on the cutting edge of sourcing deals and networks. And so nothing against the story franchises. And so I think that's one of the rationales of some of these institutional limited partners. And I think where I'm most excited is that the outcome, the performance of Zeal Fund 1 and Zeal Fund 2 could further encourage them to continue that strategy. And then next thing you know, they're no longer new. They have reps and more exposure.
Yeah, I think that makes a ton of sense. And then going back to just, I would say like individual or family office LPs, do you think there's a certain, I don't know, like personality trait or characteristics about people that make them want to be in venture? Or are there certain subsets of people that are more common that you've had success fundraising from versus others?
That's hard to say. I've crossed paths with so many different personalities, Paige, and I do find that between the individual and the family offices, they have an interest in just the next wave, the next big thing. And usually you think of the next big thing, not in private equity, not growth stage, it's venture capital. And usually they're liquid and diversified enough to have some exposure in joining the next big thing. And so I think there's a bit of a demeanor and attitude towards just being optimistic of the future and recognizing that since I have this character of mine of being optimistic about the future, the one or at least two ways of being a part of it is either being a limited partner in a venture capital firm or investing in an early stage technology company.
Yeah, I think that's definitely true. And I wouldn't say, it's pretty hard for me to put my finger also on the type of people, like the categories of people that tend to like venture. But I think it really is just like a risk appetite too.
For sure.
People who are very comfortable with risk, like very comfortable. And they understand, to your point about like the structure of how venture works, like they understand the power law. They understand that like a lot of these investments are probably going to go to zero, and they're completely fine with that if it can lead them to a path to what that next big thing is.
For sure.
Yeah. But it's hard to say. So I think you can find that quality in any subset of people. For us, what LPs want from me, at least I would say, is like really strong communication. They want to know what's going on. They want to really know what the portfolio is doing, whether it's good or bad. A lot of them too are like pretty passionate about certain industries, and that's why they're interested in certain funds. It's not just about venture. I think it's more like maybe they really care about the next innovation in healthcare, and that's something that matters to them. And if they have extra capital to put towards it, like this would be a great place to do it.
Yeah. That's a great point, Paige. Given how long it takes for the portfolio to realize, sometimes it's 10, sometimes beyond 10 years, beyond the life of the fund, those that are considering re-upping or investing in your fund, they're looking at other things that prove that you're a quality manager. how's your team? Has it been turnover? To your point around communicating, I think there's a high bar, I think, in terms of the quality and communication, particularly as it relates to companies that may not be performing well. Like how soon this idea of no surprises, the moment you surprise an LP, or in this case, probably all of your LPs, they're going to possibly give you a red sticker before they go
You're
ahead.
living off like the TVPI, and then
Exactly.
that can drastically change in a year. And because if you're not careful about really being honest with yourself and what's going on with those portfolio companies.
Exactly. Exactly. And I think the other is, are they actually smart investors relative to their categories or their focus areas? And so for us, I share with the team, like, the goal is this moonshot John F. Kennedy idea is like, I want us to be the absolute best category specific venture capital fund in the world, firm in the world. And if you are an entrepreneur and you're building a fintech company, a healthcare company, a workforce employment technology company, Zeal should be the top 5 venture firms that you think of as your preferred investment partner. We got to win that. We haven't won that yet. And in order to do, we have to continue to go deep and continue to unbundle our subcategories. I do think it's an upside of living in DC as well. And if you don't mind, I'd love to share more about why we want
Please.
to be amongst our peers. And again, nothing against New York City and Silicon Valley and even Boston, where 80% of capital continues to flow, by the way. But I think it's power in a city like Washington, D.C., which is a global, notable city, first of all, but also, and this is subjective, that we're investing in categories that can be highly regulated, that can cause for new legislation changes. And so you think about policy and the red tape that could prevent these companies from scaling. But yet you have strong ties to Mass Ave, Brookings Institution, and New America, and all these really powerful think tanks that inform data around these categories and policy around these categories. You have Capitol Hill, you have 1600, you have federal agencies, Department of Commerce, SBA, Treasury, and healthcare. And then we have an emerging collaborative investor ecosystem, tech ecosystem. You have founder ecosystem. And I am just so bullish on the power of our local assets. And that goes the case for other cities. Nashville, an incredible healthcare hotbed. John Hopkins, Baltimore, very similar, education and healthcare.
Yeah.
So I think that really excites me. And I think that can be a huge differentiator for limited partners when selecting GPs. Zeal, 74% of Zeal's portfolio, their companies are headquartered outside of Silicon Valley, New York, and Boston. If I do a quick market map of my current GPs, there's no overlap, and that's attractive. So let me have exposure in Zeal. And so I think that's going to continue, and I'm really bullish that we can lead the charge in that regard.
I'm sure I could not agree more with that. I'm a huge fan of DC, having been a founder here that raised capital, but also having been an investor here for a long time and a VC, and like just seeing it grow. It's a totally different place than it was 10 years ago, and I think it's really getting to a point where it's a flywheel. Like it's a really strong ecosystem, and I think it's starting to feel much more connected instead of fragmented like you have in some of these smaller hubs, which I think I think that venture will be everywhere in the U.S. eventually. I don't think it'll be isolated, but I do think right now, at least for the next 10 years, this is a really good area to be in. Okay, I want to switch gears a little bit and ask you a couple of other questions.
Okay, fire away.
Yeah. So what would you say, the whole point of this podcast, this particular season of the podcast, is about inside baseball of VC, like the things that you wouldn't know from the outside or really wouldn't understand and nobody talks about them. So what, from your perspective, has been the most surprising inside baseball thing about venture capital?
I think the most surprising is understanding the difference between being an investor and being a fund manager. The difference between raising a fund and building a firm. Now, and that continues to be so eye-opening, and in many cases, Paige, I am still flying the plane as I build it. I think being a fund manager has taught me to understand there should be no ambiguity in talent management as you think about the framework to train your most junior. And they, no matter how young they are, they should be able to see a path towards partner, to ensure that your investment process is repeatable, is transparent, is flexible. You're leveraging fees, not just for human capital, but for technology, especially in the day of AI. I'm also learning about post-investment value add. When you're a lean team, how can you become creative and recognize areas where you spike the most? You can't be everything to every entrepreneur. So what are at least three things where you can lean in and maybe leave the other stuff to the other cap table investors? Branding is important for me as the founder of the firm. There's a bit of an overlap between personal and firm brand. My goal is to continue to expand that, where everyone is getting exposure on stage, thought leadership pieces, tweeting, whatever you call it, posting, everyone's showing that they believe in the model, believe in the mission, and it doesn't always have to be me to speak on behalf. As if we're like the idea of we're all rowing in the same direction. And so having that internal buy-in and me feeling comfortable for others to go out and lead conversations is important. So that's like inside baseball, where I thought I was just going to raise capital and execute this strategy. But there's these other things that you have to, so much more to it. And honestly, it's really exciting. It's frustrating. Not all that is sexy, but it plays a role to getting to that liquidity event, right? And it makes it all worth the while when that happens.
Yeah, you're so right. I was just saying on another recent episode, I'm nostalgic about when I used to just be an angel investor. It's just, you don't have to care about all the things you just talked about, right? Those are you have to reinvent yourself to be almost like a different leader, to do all those other things as a fund manager, versus when you're just an angel, you're just writing checks and you don't have to have portfolio construction. You can just make bets on a deal by deal basis, and it doesn't really matter to anybody except for you anyway. So but there's a lot of, I think to your point, there's a lot of, what would I say? It's very rewarding to build a firm, right? To see other people around you grow and to share what you've learned with them and really know that you're making a difference in the future of the things that get invested in, because that's really important.
That's right. Yeah. That's right. And you have the ability to change people's lives. You have the ability to, whether it's your team, because at Zeal, everyone has carried in the GP. Whether you're Kelly, who is my EA, or you're Susanna, our head of portfolio management, it's important that everyone understands that when we all win, when the founder wins, our limited partners win, we win as well. And my hope is that's part of the value prop to retain talent as well, which is very difficult, particularly in venture.
Yeah, it is. Okay, what would you say has been your biggest failure, and what have you learned from it?
I think my biggest failure, Paige, has been when I first started the firm. I didn't spend enough time on the talent management framework. I think I was so focused on fundraising. I was focused on building, sourcing companies, but I didn't take care of home as much. And I think that it yielded a lot of ambiguity. I've learned from that. I've had several postmortems, and I credit previous Zeal employees. I credit my executive coach. I credit my sponsors and other GPs who have shared framework. So if it does happen again, it's for another reason, but it's not because there's not an alignment or transparency. And so for all those fund managers who are looking to raise capital and build a firm, don't lose sight on making sure that you are clear on you're clear on your talent management framework. And I'm so grateful for that learning experience.
Yeah. I feel like I've made the same mistake myself. And then the last thing I was going to ask you is, what's the best advice you've ever received? And this doesn't have to be in venture, but it can be.
It sounds so cliche, and I think you've heard this quote, is that to whom much is given, much is required. I grew up on the other side of the tracks, didn't have much, had a lot of love, went through a number of nonprofits that taught me entrepreneurship, leadership, service, understanding different career opportunities, the importance of gaining a solid skill set. Networking is one thing, but intentional networking, building meaningful relationships is another. Gaining financial capital, like saving your money and being thoughtful in that regard. And so, transparently, I know that there's not many fund managers that look like you and I, and there is a responsibility for me, and I will always make time for the next generation of investors that look like you and I think that is the future of venture capital. That's the future of this country. And if entrepreneurs are truly going to be the change agents of this country, then it has to include everybody. And so my focus is to whom much is given, much is required. There's been a lot of people and moments that I've navigated, and people have poured into me, and it's just a responsibility and necessity that I do the same for the next generation.
Yeah. That's a really good point, and it's a good reminder to have. You get so caught up in the business and the investments and the companies, and you forget that you're pretty lucky to be here, right? No matter who you are, and have a responsibility if you have gotten that luck.
Absolutely. That's right.
Cool. Any final thoughts?
I'm just really excited about this next vintage, like what this vintage is going to transpire in terms of the next game-changing companies in healthcare and fintech. I'm really excited about our portfolio currently. Seven Starlings is a women's mental health platform based in our backyard in Bethesda. We just closed a Series A investment alongside Para VC and Emerson Collective. I'm excited about a company called Rising Team, led by Stanford GSB professor Jennifer Dulski. Sold her last company to Google, a navigation business now. Built a workforce company that's rethinking employee engagement and retaining top talent. And then there's companies like Seago Seguros out of Fund One, that's an insurance company for the Hispanic population, growing over 50% year over year. We just closed a Series A extension. The founders are going to surprise us, even in a tough market. They're going to extend their cash a little longer, still hit their milestones. And I think from a liquidity perspective, also, Paige, I think you're going to see more secondaries. In 2024, we had $50 billion in total secondaries. We're recording today, and it's June. We're at mid-June, and we're at $60 billion already. And I think at the end of 2025, we're going to see closer to $100 billion in secondaries. If you unpack secondaries from a private markets asset class, about a fourth or a third will be venture capital. And so that's, I think, investors finding, particularly for the early investors, finding ways to seek liquidity that could hopefully allow managers to fundraise. But then you have IPO markets that are thawing out, particularly in fintech, where you have Circle and Chime coming out of the gate. And then you may have others, not Plaid, others, fintech that may become IPOs. And so thawing out a little bit, not incredibly active as we all would like. But given that, I still think M&A and secondaries would be the primary source of liquidity over the next couple of years.
Yeah, I do too. And I'm glad about it, actually. I think everyone's always been wondering, venture is just not And like part of the reason why I think it's not available to this, it's only available to accredited investors is not just because it's high risk, but because it's highly illiquid. Creating liquidity around that allows a lot more people to participate, which is exciting.
Exactly.
And I think you're right. The founders in difficult times, they find a way, like they rise to the occasion. It's hard and maybe they can't raise as much money, but they find a way. And so I couldn't be more optimistic about this cycle that we're in right now.
I'm right there alongside you. Paige, thank you so much. I really appreciate this conversation.
Thanks so much, Nasir. I really appreciate the time. That's a wrap.